We are here again with Mike Zuzolo, President of Global Commodity Analytics. And Mike, please explain us a little bit about this soybean correction we are seeing on this Thursday.
Yeah, Luis, I think this goes back to what we've been talking about on your show for the past several weeks, as far as whether this is a supply-led market or a demand-led market. And I think this week we've gotten an indication that it is really a supply-led market. That's not to take away from the demand, but I think what the market has been contending with ever since the USDA crop report, especially, is we know the 140 million bushel carryover for the United States. That is a known fact now, but we don't know what the South American crop is. And I think the trade, me included, we're thinking that the Brazilian crop estimate of 133 million tons was way too high, maybe as much as 5 million tons too high. It goes back to where we were last year. Brazil did 126 million tons of soybean production last year. USDA is lowering the corn number. They're lowering the corn number in Argentina and Brazil now, but they're not lowering the bean number. And so up until this week, I think most of us were sitting here thinking, okay, USDA is just taking their time because Brazil has been slow and got a late start in planting. They're getting a late start in harvest. Well, then we saw Data Grow's numbers come out and some other private estimates come out, and they're right up there at that 135, 134, 133 level. And I think this is where the supply market comes back in. And so I think we've rationed demand in the crush. And I think that's why the meal is our leader to the way down right now. We've made new weekly lows in the meal. We've taken out an important trend line in the daily charts. We've taken out some short-term moving averages that have been in place for a couple months. And so the meal market is, to me, the demand market. That's the one that we're really rationing demand because the crush values are going down and weights are dropping. And so the meal is leading the soybeans down. The soybeans can't go up with weather or supply because of what we found out after the USDA report and not knowing whether this drought has really hurt the soybean crop in Brazil or not. And I think that's really where we sit. And I'll add one more thing that's maybe more esoteric and less concrete. I think the trade feels really comfortable trading technicals right now. I don't think they want to try and figure out the fundamentals between the strike in Argentina, between the still dry areas of Mato Grosso and Mato Grosso do Sul and Santa Catarina, and then the Argentine Pampas. There's so many fundamentals right now that seem uncertain. Just today, before we went on the air, China has said that they're going to have they have had their first African swine fever case in about 3 months. And so what does that mean for meal demand? What does that mean for bean demand and bean crushing over in China? So I think the trade's pretty comfortable trading the technicals right now and trading the momentum, and especially in light of this post-USDA number.
And that goes back again to the sell and the fan strategy that you always talk about, and the importance of that strategy.
It really is. And I think it really is from a standpoint of we don't know how much demand we've lost. We really don't know if China is going to be able to take on another 100 million tons of soybean imports this next year. And I say that because while China's economic data looks good on the surface, as I've been digging into it, their consumers are not coming back like they were before COVID. And it's been mainly the government-led stimulus and much like the rest of the world. But I think the agriculture markets have this mindset that maybe China's different than the rest of the world right now in how they're coming out of COVID. And from a consumer standpoint, they're not that different. And in fact, the South China Morning Post just reported that the many Chinese government agencies and companies are paying workers in major cities like Beijing to not travel to, during the Lunar New Year, which is coming up around February 12th, and it lasts typically about 3 weeks. They're paying them not to travel this year. Taiwan is setting up very strict checkpoints, and in some areas, they're not even having a Lunar New Year from some of the reports I've seen. And so I think this demand issue is still an issue, and we've talked about this for probably 6 months now, as far as that phase one trade deal. How much demand does China really have, and how much is has been bought forward because of COVID and the fear that they wouldn't be able to get boats on the ocean and ships, organized because of the labor issues and the port issues because of labor. And I talked to USDA about that about a week ago, and unfortunately, it was a domestic agency, and they didn't want to speculate on if China had been buying forward on the soybeans, but I sense they have.
Yes, and what do you think of this scenario? How do you think this scenario will impact on planted acres in the coming months?
Yeah, that's a really good question. It's a hard question to answer because it depends on where we're at in prices when it comes to February, because February is the month that the crop insurance industry has its base price factored. In other words, that month of February is when we figure out how much we can protect as producers in the United States based upon how much percentage crop insurance we get and we purchase. And so the difference between $11 November soybeans and $12 November soybeans could be a significant change in acreage base. And we see that we've hit the $12 mark. We're going back towards the 11.75 mark. But what happens if, as we get into the 1st of February, Brazil is harvesting, their yields are decent, the soy meal hasn't come back, and all of a sudden we're starting to talk about 11.25 or $11 soybeans in the new crop November contract as we get into the month of February and as we go through the month of February. I think that will buy some corn acres and that it will at the expense of beans.
Yes, and how do you see the macro side impacting corn prices? We are seeing right now West Texas intermediate oil above $50 a barrel.
This is another really tough one to answer because we have a new administration here in the United States for the presidency who has made it a very strong policy for climate change. And he's already moved, President Biden has already moved on the Keystone XL pipeline and taken that down and is not moving forward with that. What I think is going to happen, Luis, is that we are going to see smaller oil producers in the United States start to contract and reduce production. At the same time, I think ethanol producers will contract and we'll see lost production there. Now, does that send the ethanol price higher, and does that send the crude oil price higher and signal to the corn market and the investment funds to buy more corn? And that, I think, is a possibility in the futures market. Or does the cash market realize the demand is not going to be as strong because refiners are not going to blend as much ethanol, and therefore the cash market and the crude oil and we lose exports in the United States for crude oil, then that means that we have lower cash prices in crude oil and ethanol. And so what I'm talking to clients and subscribers about right now is the idea that we could have a dual market, a divergent market between the cash and the futures in corn and crude oil for that matter, where the cash market is very weak, basis is very wide, but then the futures market could be very, very strong because the funds see prices going higher on tighter supplies. And I think in the middle of all that is the unleaded gasoline demand and how we come out of COVID this spring and whether we get our summer driving season back this year and our summer grilling season back this year. And we're kind of back to where we were last fall or at the beginning of last summer. And we're quickly getting into that time period.
And which one of the two crops would you be selling first, corn or soy?
I'm still selling more soybeans at this stage because of the price level we're at. And I do participate in the idea that USDA is seeing the South American corn crop going down faster than the South American soybean crop going down. I would also say I think there's going to be less competition around the world in the first 6 months of this calendar year for corn to come in and hurt the United States business. And I think, again, given our weaker dollar and some of the prices in Europe and especially the Chinese corn price, we are very cheap. It wasn't just last week, I believe, where the United States Gulf price of soybeans went above Brazil's Paranagua price for a short period of time. So the beans have done a much better job holding a bigger premium in the United States against some of our competition. And I think, again, we talked about that, I think, last week, and that's going to be a real important indicator is if the Paranagua port price for soybeans starts to drop as the Brazilian farmer harvests more and more, that's going to be a leading indicator for me to say, okay, maybe we do have a temporary or short-term high in place, and it could be a lot like 2007, 2008, where we have to wait till springtime to regenerate the rally. That I think that's what this week and next week are probably going to help determine.
Oh, well, let's talk about wheat right now. Mike is located in eastern Kansas. So, how is the weather there right now?
Well, we're warming up and we're drying out. And so the weather models that are showing more rainfall and some more snow as we go into the end of the month are very important to us right now. And especially as you go out west, we had very severe winds last week that probably caused some damage in our conditions of our crop, in a wheat crop especially. I think, the NOAA 30-day and 60-day outlooks came out this week. We just today saw the new drought monitors. Both of those suggest continued dry weather for the plain states and the hard red wheat belt, especially. So I think the wheat can correct, and it probably should correct here. It'd be healthy to correct to get some more demand because our exports seem to be sliding some, not as good as we have been seeing lately, or as of the last couple months. We did sell some hard red wheat out to the Asian Pacific Rim, it looked like on Thursday, I believe. And that was nice to see. But I think the bottom line for me is a correction would make sense, Luis, but I think there's still a floor underneath the hard red wheat price because of the weather and how we go into the springtime.
Yes, and what's impacting from abroad the price of wheat?
Well, we've priced in, I think, pretty effectively the Russian export tax, and I think we've adjusted to that in both the Ukrainian price, the Russian price, and the United States price. And that's why I think maybe the world buyer wants to wait now to see if he can't get a little bit cheaper prices before locking in a lot more and booking a lot more. We saw Tunisia come in. I believe Algeria was coming in. We had a recent purchase from Egypt. It's been pretty active. It's just the United States hasn't been getting the business. And so I think from a holistic standpoint globally, it would make sense that maybe we would see a little bit of a slower base from the consumer or the end user, the world commercial side, maybe because of COVID and the expectations that COVID will go away and they don't need to buy extra and ahead. So, I mean, this next 30 days, it would not surprise me to see a correction led by the soft red wheat. One thing that happened on Thursday that needs to be watched real closely is both the soft red wheat and the hard red wheat went back into a carrying charge, meaning the March contract went below the May contracts for both hard red and soft red. That's indicative of the carrying charge is indicative of the demand maybe getting weaker because you're not putting that premium in the front end and in the front end contract, asking the producer to sell right away. You're starting to promote the idea of the producer to store more wheat. And so if that carrying charge builds into the end of the week, that's another indication that maybe the demand is softening up in the next 30 to 60 days.
That's another correction on the table.
Right.
And before we jump into livestock, I would like to ask you about more about the macro side. What are you seeing right now in terms of interest rates and the new regulations that are coming?
Yeah, these are two things, along with President Biden's fiscal stimulus bill, that are going to be extremely important to the markets, whether the equities markets or the interest rate markets or the currency markets. My sense right now is that the equities markets has built in a premium for both the fiscal stimulus and that $1.9 trillion, and also some real headway to be made when it comes to the pandemic and the COVID vaccination program. If we don't see, and I think also it is built in a premium with the idea that the real economy will start to show some gains, that we'll start to see some improvement in the real economy. But I think we're on a timeline here, Luis, where we need to see those gains happen in the next 30 days. We need to see that fiscal bill passed in the next 30 or 40 days. So as we get into February and as we get closer and closer to March, I think the equities markets and the bond markets both will become very nervous if they don't see what they're expecting and what they've priced in. So I'm still looking for ways and a time period and some sell signals to get into some S&P puts and to put a floor underneath me in the equities markets, thinking that we've overdone this market if the real economy and that fiscal stimulus bill don't show up and show that we are making improvements here in the United States in the next 45 days or so.
And what are you recommending right now for the animal producer?
We've got a new thing on the table, and it's called African swine fever. China came out just today and said that they've got African swine fever for the first time in 3 months. Meal prices are very strong in China. Their meal stocks are down right now. I think they're the lowest right now nationally since May, based upon some of the numbers I keep track of. And so we have had a herd rebuild. We can see that in the meal stocks drawdown, but this African swine fever throws a whole nother wrench into the works, as we would say. And I think it could be a situation where the hog market, between the domestic PRRS and other disease issues we have here, and what African swine fever is starting to show up again in China, it could be that the hog market, the funds may want to buy this hog market because seasonally it's not a bad time to do it, especially as you get close to February. So we may be back on it where the hogs want to try and take the cattle higher. We've, I think, already seen some of that with these front end cattle getting back up to that 113 and then jumping up towards that 115 level. And we've got the April fats now back to 120. I'm still a hedger at these price levels. The live cattle for the April 120 hedges that I have on here, this 119, 120 level, I've been selling and hedging with futures. If I think the hogs are breaking out to the upside, I'll probably convert those. I'll probably buy those futures back for hedgers and come in and buy April puts and just have a known cost floor underneath me instead of short futures.
Be prepared for the worst. That's Mike's suggestion.
That's exactly right.
Thank you, Mike.
Thanks, Luis. Have a good week.